Welcome to The Explainer. Today, we're unpacking a true modern disaster, the 2008 financial crisis. This was an event that quite literally derailed the American economic train and triggered the worst global downturn we'd seen since the Great Depression. It was a crisis that pushed the entire international financial system to the absolute brink, wiping out trillions of dollars in wealth and changing millions of lives forever.
So, here's how we're going to break this all down. We'll start with the roots of the crisis, see how the housing bubble burst, track the collapse of the major banks, look at the global economic fallout, and finally, cover the recovery and Wall Street reforms.
To really get inside the psychology of this meltdown, you have to hear this incredible quote from investor Warren Buffett. He basically said the whole thing was like Cinderella going to the party. It beautifully captures the mass illusion taking place on Wall Street at the time. I mean, everyone knew the housing bubble was totally unsustainable, that the underlying math simply did not work. But the profits were just way too good to pass up. You had institutions, lenders, and the public all buying into this system built entirely on speculation, and everyone was just hoping to cash out right before the clock struck midnight.
Let's dive right into part 1. Roots of the crisis, cheap credit and toxic mortgages.
Okay, so the seeds of this historic disaster were actually planted way back in the early 2000s. We had just gone through the burst of the dot-com bubble, massive corporate accounting scandals, and the September 11 attacks. So to stimulate a really struggling economy, the Federal Reserve stepped in. Between May 2000 and June 2003, they aggressively slashed the federal funds rate from 6.5% all the way down to just 1%. That created an era of incredibly cheap credit. Money was suddenly available at bargain rates, which fueled an absolutely unprecedented demand for housing. And this massive demand? Well, it was increasingly met through something called subprime lending. Lenders literally threw traditional underwriting standards, the rules banks normally use to make sure you can actually pay them back, right out the window. They started aggressively targeting borrowers who had poor or even zero credit history, handing out complex, high-risk mortgages for homes that were priced way beyond what these people could afford. Many of these even had sneaky introductory teaser rates that were designed to skyrocket later on.
Now, you might be wondering, why on earth would lenders hand out money they knew probably wouldn't come back? Well, the magic word here is securitization. You see, the banks didn't actually keep these bad loans on their own books. They sold them off. Wall Street investment banks would swoop in, buy up these highly risky subprime mortgages, bundle thousands of them together into these complex financial products called mortgage-backed securities, and then resell them. And here's the really crucial part. The credit rating agencies assign these bundles their absolute top investment-grade ratings. It created a complete illusion of safety. Believing those flawless ratings, corporate and institutional investors all over the world bought up these hidden toxic assets, completely unknowingly spreading the risk across the entire globe.
Moving on to part 2, the housing bubble bursts, the turning point.
So, the music at Cinderella's party finally stops somewhere between 2004 and 2006. The Federal Reserve sees inflation creeping up on the horizon, so they start raising interest rates. And as soon as those rates go up, the cost of those adjustable rate mortgages shoots right up with them. Suddenly, demand for housing plummets, and this massive bubble begins to rapidly deflate. By early 2006, home prices are actively falling, which leaves countless homeowners stuck with properties worth less than the massive mortgages they took out to buy them. Which brings us to a staggering figure, 50 million. Out of 75 million homeowners in the US at the time, roughly 50 million held mortgages. Like Warren Buffett pointed out, the fallout of these tanking home prices instantly impacted 40% of American households. This wasn't just a shock to speculative Wall Street traders. This was a systemic gut punch straight to the American middle class.
The contrast between the boom and the bust was just night and day. During the boom, rising home prices and easy cash-out refinancing basically acted like a giant Band-Aid, hiding all the immense risks of those subprime loans. If you couldn't make your payment, no problem. You could just refinance or sell the house for a profit. But during the bust, which really accelerated in 2007, that safety net just completely vanished. Borrowers started defaulting in historic numbers. And as a direct result, trillions of dollars tied up in those supposedly safe mortgage-backed securities sitting on the books of major financial institutions just evaporated. They became worthless almost overnight.
Which leads us directly into part 3, collapse of major banks, the domino effect. Picture this. Suddenly, banks don't know who is holding these worthless toxic assets and who is actually safe. There's this profound, suffocating lack of confidence, and the entire system just paralyzes. Banks literally refuse to do business with each other. The global interbank credit market, basically the plumbing that keeps the world's money flowing, freezes solid. By 2008, the dominoes are falling at a terrifying speed. In March, Bear Stearns, a Wall Street giant that had been around since 1923, just collapses under its own toxic mortgage weight and gets sold off in a Federal Reserve-backed fire sale to J.P. Morgan Chase. Then, over the summer, IndyMac Bank fails in one of the largest bank failures in U.S. history. By September 7th, the government is forced to step in and seize Fannie Mae and Freddie Mac, institutions that together owned or guaranteed half of the entire U.S. housing market. And then, on September 25th, Washington Mutual goes bankrupt after panicked depositors pull out $16.7 billion in just 10 days.
But the absolute, undeniable climax of this whole thing hit on September 15, 2008, with the collapse of Lehman Brothers. Now, unlike with Bear Stearns, the Federal Reserve actually declined to guarantee Lehman's loans. So this 158-year-old firm, the fourth largest investment bank in the U.S., was forced to file for the largest bankruptcy in American history. That single event sent absolute shockwaves through the global system. The Dow Jones plummeted, a massive run on money market funds began, and the panic was just absolute.
That brings us to Part 4, the global economic fallout, a systemic meltdown.
After Lehman fell, the financial markets literally went into freefall. What started as a Wall Street liquidity crisis rapidly transformed into the brutal, everyday reality of the Great Recession. The credit markets were squeezed so tight that everyday businesses suddenly couldn't roll over short-term debt just to make payroll. The entire economic engine of trade and consumption just ground to a halt. And the human cost here was totally devastating. Assessments show that an estimated 8.7 million jobs were wiped out in the United States alone. Unemployment spiked to 11% by October 2009, that's roughly double the pre-crisis rate, and the poverty rate across the nation rose incredibly fast.
To really put the sheer scale of this financial destruction into perspective, let's consider this figure, $11 trillion. Between the second quarter of 2007 and the first quarter of 2009, $11 trillion in U.S. household wealth simply vanished into thin air. The stock market completely crashed, with the Dow dropping 53% from its peak, while property values absolutely bottomed out. Estimates actually suggest that 1 in 4 households lost 75% or more of their total net worth.
And we have to remember, those toxic securities were owned all over the world. This wasn't just an American problem anymore. This contagion spread across borders like wildfire. Iceland actually suffered a complete systemic collapse when its 3 major banks failed, triggering a massive currency crisis. Ireland's booming economy practically fell off a cliff. Greece spiraled into a devastating government debt crisis that eventually morphed into the larger euro area crisis. International trade, foreign investment, it all slowed to a crawl, hitting both developed and developing nations incredibly hard.
Finally, we reach Part 5, recovery and Wall Street reforms, putting the train back on the tracks.
To stop the global economy from literally disintegrating, central banks worldwide held these frantic emergency meetings and coordinated massive interventions. Governments had to step in, effectively flipping central banks from being the lenders of last resort to the buyers of last resort. They pumped unprecedented liquidity straight into the credit markets. Over in the U.S., lawmakers were given stark warnings that the entire economy might collapse over the weekend. So, in October 2008, Congress passed the Emergency Economic Stabilization Act, which authorized TARP, the $700 billion Troubled Asset Relief Program. The Treasury used that massive fund to buy up toxic assets, inject capital straight into failing banks, and throw lifelines to auto giants like General Motors and Chrysler.
Now, the crazy thing is, those government investments in the banks were actually recouped later with interest. And the bailouts did ultimately get the economic train back on its tracks. But man, did they spark massive public outrage. People were furious watching executives from these bailed-out institutions sitting comfortably at Senate hearings. The overwhelming perception was that the exact same people whose high-risk, anti-competitive gambling had tanked the global economy were walking away rich, simply because their institutions were deemed too big to fail.
So in the aftermath of all this, we saw sweeping regulatory overhauls designed specifically to stop these practices from ever happening again. In 2010, the U.S. passed the Dodd-Frank Act to totally revamp financial regulations and keep a much closer eye on mortgage and credit card sellers. On a global scale, the Basel III capital and liquidity standards were rolled out, essentially forcing banks to hold on to much bigger safety cushions to absorb any future financial shocks.
So here we are today. The global economy is functioning and the banking sector is undoubtedly far more regulated than the Wild West of 2006. But history teaches us a really sobering lesson here. From the Dutch tulip bubble in the 1630s all the way to the 2008 housing crash, financial bubbles are basically a human constant. They are driven by greed, easy money, and this persistent illusion that the good times are just never going to end. So the question we really have to ask ourselves is this: have these new regulations actually fixed the underlying incentive systems, or are we just waiting around for the clock to strike midnight on a brand new party?